market movers. This is The Pulse.
Good morning, everybody. Welcome to The Pulse. I'm Anna Edwards, live in London, and these are your top stories. The global chip rout deepens on AI spending fears. Slumps in Samsung and SK Hynix point to cracks in the memory chip boom. Barclays shares slide the most in more than a year, despite the UK lenders, equities traders and investment bankers beating estimates. Plus, oil and gas fall further as President Trump says there's a good chance of a deal with Iran, but Tehran denies formal talks are taking place. Let's check on some assets for you then. Real weakness coming through from the Asia session. It isn't just the Kospi, but the Kospi certainly stands out. Very driven by two individual stocks, of course, but down by 10.8% just in one day on that major market. The Japanese market also under pressure. Nasdaq futures then looking to pick up that negative baton by the time we get to the US session, and Nasdaq futures are down by 1%. In amongst all of that, we're pretty flat on the euro dollar. The Brent price, though, thankfully does continue to retreat. We're down by 2.8%, 85 now the handle on another calm night in the Middle East. Let's take a look at the European markets map, because this tells a very different story to the tech rout we've been talking about. There's a lot of earnings news in here. There's also a lot of resilience, it would seem, in European stocks, resilience away from that tech story. And so that seems to be where Europe is playing its card this morning. We see personal consumer goods companies doing pretty well on the back of maybe some haven flows and some earnings. Let's just get up to date with what we're doing on SK Hynix, on the ADRs there in pre-market, just to give a sense of where this trend goes. It looks as if we've got further selling to go. We saw selling on the Philadelphia semis index yesterday. That went into Asia. We see a continuation of that through the Asia session, and it looks to be into the US session once again, with those ADRs under pressure. So the global rout in chip makers has deepened further, looks to have further to run. The losses coming after a Chinese state-backed firm reportedly began producing machines that could rival ASML's dominance in that space. Meanwhile, rising levels of corporate leverage have pushed the cost of insuring Nvidia's debt higher after it announced fresh deals. Let's talk to Bloomberg senior strategist Neil Campling, who can bring together some of these disparate threads, a host of factors then weighing on the tech trade, weighing on our confidence around chip stocks, Neil, and not just chip stocks, but those companies that make the equipment that makes the chips. Let's go there first, because we do seem to be worried about Chinese competition in lithography. To some degree, this was Europe's story yesterday. ASML was considerably weaker on this story in yesterday's session. But how should we think about Chinese competition right now?
I think, Anna, the issue on Chinese competition is concerning to many players in the market because, of course, we've had lots of IP restrictions on technology going into China. And yet somehow China seems to have gone up the technology curve substantially in terms of the ability to produce chips, the ability to create AI frontier models, and potentially now even into chip equipment, which, of course, ASML is really the monopoly for both what they call deep ultraviolet, DUV, and EUV, extreme ultraviolet machines. So that's where I think the concern is coming in from that. And then with regards to the likes of the Nvidia situation in terms of the circular deals, this isn't a new story in of itself, but the numbers mentioned in terms of dollars continue to move higher and higher. And the worries are how much of the AI ecosystem is being, if you like, artificially inflated by Nvidia's kind of financing of their own ecosystem.
OK, and so all of this sets us up for an earnings season still to fully play out from the big hyperscalers in the United States, Neil, in a very nervous fashion, doesn't it? We're concerned about circular financing around Nvidia and the AI space. We're concerned about Chinese competition, just how much of a build-out do we want to see from these chip companies? And then we're waiting for at least 4 really big corporate earnings from the tech space this week.
We are indeed, and I think the kind of the litmus test last week was the fact that Alphabet delivered their first ever quarter since going public of negative free cash flow. So what are we going to hear from the other tech giants this week? And as you mentioned at the top of the hour, regarding to the increasing cost of the debt within the hyperscaler sector. So we want to see where the free cash flow trends play out, and then whether any of those big tech firms will actually blink first and slow the pace of capex. That's not something that we necessarily know just yet, but it's certainly something to watch for this week. Meanwhile, of course, there is another big tech company, Apple, who are not investing hundreds of billions of dollars into the AI race. They're probably waiting to see who wins out, and then we'll sign a deal later on down the line, I think.
OK, and we get earnings from Apple as well, don't we, this week? Neil, thank you very much. Thanks for the update. Bloomberg Senior Strategist Neil Campling pulling together all of the themes that are weighing on sentiment around technology. Let's talk now to Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Very good to see you, Laura. Thanks for coming in. How concerned are you then about the tech dynamics? Do we set aside what we see on the Kospi and say that's a very different market, it's very volatile, it's very influenced by just two companies, and they have a fairly volatile track record recently? Do we set that aside as being different, or are you overall concerned about what we see in the tech landscape?
So there are idiosyncratic factors that are driving the Korean stock market in particular, most notably the ample leverage in the system. And yes, we are seeing a high degree of correlation with the U.S. NASDAQ. But I think at this juncture, we're not overly concerned about drawdowns in the tech space. And that's largely because of the earnings backdrop does remain exceptionally robust. There's questions around the return on investment from a lot of this CapEx spend, but we're not yet seeing signs of cracks there. And even if we look at margin expansion, really it's being driven by tech. So not any meaningful concerns. The key risk, I think, to watch for is when we see that first hyperscaler signal they're going to pull back on CapEx. I think that's when we could start to see some of this momentum really start to falter.
Yeah, it's interesting, isn't it? As we look ahead to so many earnings reports from these hyperscalers, Laura, you're pointing to the CapEx number, which I'm sure is where everybody is focused. But it's hard to know how the market is going to receive these CapEx numbers, because on the one hand, if you give a big number, does that express confidence? But also then, does that make people nervous about how much you're spending and how quickly? So is there kind of a Goldilocks hope when it comes to CapEx and hyperscalers? I don't know how they get it right this earnings season.
Well, and it's a key question for investors. You know, how much patience do they have before they start to see real meaningful returns on some of this investment? So far, investors seem to be continuing to want to bet on these big AI ambitions, and I think that's going to continue to dominate. If we take a step back, though, and look at valuations, we are seeing valuations come off their June peaks, but still well above the 5-year, 10-year averages, looking at that S&P 500. So I don't think we're going to see these AI ambitions really drive more multiples expansion. It's really going to come from that earnings backdrop. And because tech continues to show such robust earnings, we think that's going to continue to drive the market higher, albeit we're going to see these bouts of volatility, particularly in August when we're going to see lighter liquidity.
And we'll think more about the European earnings season in just a moment. But I wonder how the central bank narrative then rubs up against the tech story, because do we think that the tech narrative is robust enough to withstand higher interest rates? And will they come from the Fed even as soon as this week, Laura? What's your thinking?
Well, there's two great questions in there. I think on the one hand, you know, the hyperscalers and the amount that they're tapping into the debt capital markets in particular at the longer date of the curve, that's actually adding to this higher for longer yield backdrop. So that does add a little bit of a conundrum, let's say, for the Fed. But I think the Fed is going to be really the key event risk of the week. And that's because very unusually markets are pricing in, you know, about a third chance that they could hike. That's double where they were a week ago. And that's very unusual. If we look over the past decade or so, the Fed has well telegraphed what the moves could be. And so I think this is investors having to grapple with this new worse regime of no Fed guidance. So I really am watching for that rate decision tomorrow.
Yes. And so, so 30-40% expectation that we get a hike as soon as this week. As you say, we don't normally go in with such sort of divided opinion. But this is by design, isn't it? The Fed chair wants us to think more carefully about the data we receive and make our own judgments about whether rates will go higher. Do you think then that we're going to end up with higher rates? How many hikes do we get this year, Laura?
Oh, that's a great question. It's less about when, but more about, it's less about if, but more about when. But I still think at this case, if the Fed is data dependent, like they're saying they are, the data since the last meeting, well, we've had softer than expected inflation. We've had a weaker payrolls print with that June around 57,000 for the headline. So the data itself doesn't suggest the Fed needs to hike in the near term. But that being said, we do have oil price volatility that's come back into play. That can lead to higher core inflation. And as well, if we look at the June meeting, just the amount of Fed members that were quite hawkish, anticipating anywhere from 1 to 3 hikes this year. So I think we're going to see, greater dissent. I think we're going to see, more speculation that the Fed could potentially hike rates. But if they do go tomorrow, markets are likely to extrapolate that even further, and I don't think the Fed is at that juncture where they want to do that because the data doesn't support it. So I think on pause for now, and we're still leaning against the need for a hike this year.
Okay, Laura, thanks very much. Stay with us. In fact, we'll get your thoughts on the earnings season in just a moment. Laura Cooper from Nuveen. Now, Barclays equities traders posted their best second quarter haul in 4 years, driving an earnings beat and an upgrade to the British Bank's annual outlook. But that hasn't been enough to impress investors. Shares falling in early trade. CEO CS Venkatakrishnan told us he remains optimistic about the outlook.
I'm absolutely pleased with the set of numbers we've published today. Our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about.
CS Venkatakrishnan there. Bloomberg's Charlie Wells has been looking at all of the details here that we've got from Barclays this morning. Charlie, good morning. So what does the share price reaction then tell us about perhaps the expectations going into this print? Is that what they've become a victim of this morning?
Well, Anna, that's a very good question, because this red behind me really is one of the key puzzles of the market this morning. Barclays reporting a really solid set of results. They beat on a number of fronts. They beat on equities. They beat on investment banking. And what we're really picking up on so far, if we flip and take a look at some of the misses here, that really seems to be what a lot of traders are focusing in on here. FIC in particular, right? You can see a miss there. Not a huge miss, but one that the market seems to be paying attention to. You see softness in that U.S. consumer revenue as well. And again, some difficulties here on operating expenses. So again, a solid set of results. They were in line with the trend that we've seen at a lot of global investment banks, but the market this morning not liking what it's seeing.
Yeah, so the market selling this stock. How do these numbers then from Barclays compare to those that we saw on Wall Street? Because inevitably, those are the kind of comparisons that get made, certainly around some parts of the business.
Well, Anna, that's one of these relativity issues, right? So even where we see beats, you can see that we're just not getting the same growth that we see in some of these American giants, right? So let's think about equities trading. This has been one of the key areas that traders have really been focusing on, analysts have been talking about. And you see in that second quarter, you see year-on-year growth at Barclays up 45%. That's a great figure, but not so much when you compare to the likes of, say, JP Morgan, where we see a growth year on year of nearly 86%. So again, this is where Barclays beat. Let's flip and take a look at where they missed expectations, because what we see is in that FIC number, you saw a little bit of growth, right? You saw a little bit of growth in FIC at Barclays, up 1.4%. That still missed expectations. Let's look at some of these other areas. Let's look at Goldman, up nearly a third there in that FIC space. So these comparables are difficult too. You're not just getting these misses, but when you compare some of the beats and some of the misses to the American counterparts, you get difficulties there. But let's just zoom out, right? Let's keep this in context. A lot of this movement is intraday, but if you take a look at the Barclays share price over the course of this year, we're up. We're up significantly, right? And we're up even compared to some, well, at least we were until today, some American competitors. So look, intraday, this is difficult, but if you look big picture, you still see Barclays in a prime position.
Charlie, thanks very much. Bloomberg's Charlie Wells with the latest on Barclays. Let's get back to Laura Cooper from Nuveen. Think about the earnings stories more broadly than just the tech space. We've talked about the tech sector already a little bit, Laura. Here in Europe, we have a standout story, really, by today's standards, because European stocks are flat. And all of that in the context of real tech selling, and the earnings stories are, in some cases, not in the case of Barclays, but in some cases are supporting stocks here. Are you looking to lean into some of the personal care companies, the more defensive companies, at a time where we're nervous about tech?
Well, I think Europe has been a really surprising story so far this year in terms of its resilience, despite everything that's being thrown at it, from the geopolitics to the energy crisis. And yes, I think there are pockets of opportunity in Europe. One area, as you alluded to, is around energy. We're seeing exceptionally strong earnings, and that is proving to be more of that geopolitical hedge. But other pockets, including banks, despite some idiosyncratic earnings stories, because valuations are relatively attractive. And there is some degree of AI exposure in Europe as well that can benefit in terms of looking at metals and miners, because the copper dynamic, we're quite bullish on copper. That's going to have feed through there. So I think there are opportunities, and we're seeing that actually translate in terms of broadening in the European earnings story.
Yes, it's interesting. You can see how companies in the basic metal space might benefit from AI. We keep asking CEOs to give us a sense of the return on investment in AI, and we're not getting a huge number of answers just yet, which is interesting in itself. You mentioned the banking sector. You do think it's cheap then, I guess. And what is it that you see that will change the cheapness on banks? What's going to drive a re-rating of this sector?
That's a great question. I mean, if we start to see signs of the European economy come under pressure, perhaps the resiliency of the consumer could start to be challenged. We'll start to see more loan loss provisions come through. But that's not our base case at this stage. We are seeing already leading economic gauges in terms of PMI have an upturn more recently. We expect the European economy to have a more pronounced recovery next year on the back of fiscal stimulus. So I think at this stage, the valuation story overlaid with the growth dynamics is still quite compelling.
Yeah, and in that context, in the European context, we have a central bank meeting this week. That's the Bank of England. You're expecting a cautiously hawkish message coming through there. Is that going to be the theme of the week then?
And I think that is going to be the key theme, in the sense that, policymakers don't want to be overly hawkish because the data doesn't necessarily support that, with both inflation and the labor market deteriorating at the margin in the UK and the US. But as well, they're also not going to want to out-dove the market or be, too dovish, because we are still dealing with geopolitics, renewed oil volatility. So the energy price risk still remains. So it's kind of threading this needle, I would say, for them. And so, yes, I think cautiously hawkish is the way to describe it.
OK, Laura, thanks very much. Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Coming up on the programme, Ukraine's president heads to a meeting with President Trump in Washington after securing jamming technology from the UK. Details next. This is Bloomberg. Welcome back. Now, President Trump says that the US and Iran are engaged in diplomatic talks to end the Middle East conflict, even as Tehran says that no formal negotiations are taking place. But President Trump also warned the two sides would return to fighting if negotiations did not result in a deal.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, good things can happen, I guess.
Let's get more details with Bloomberg Horizon's Middle East and Africa anchor Abir Abu Omar. Abir, how realistic is a deal then between the US and Iran? At the very basic level, they have differing accounts of whether they're even talking to each other.
Good morning, Anna. Yeah, you're exactly right. I mean, you heard the back and forth in the president's own remarks just there, saying that a deal is possible. But then if it does not happen, then the United States will go back to hitting Iran. Now, this follows a halt in attacks by both the United States and Iran. This is after 13 consecutive nights of strikes by the United States on targets in Iran. All of a sudden, on Friday, the U.S. stopped attacking those targets without giving any explanation. Iran later on Sunday saying that it will suspend its own attacks as a result of the U.S. halt. But when it comes to actually reaching a conclusion or reaching a deal, as President Trump had suggested, we just do not have enough clarity yet, Anna. There's no sign to indicate that there are any substantive negotiations happening between the two. President Trump did say that Iran did reach out directly and through surrogates to the United States to have conversations. Iran says through the foreign ministry that while it could send messages through mediators and delegates, there's no concrete conversations happening at the moment. And so this is what we're waiting to see, whether actual negotiations similar to the ones that have taken place after the MOU was signed in Switzerland will take place over the course of the week or over the next few days, really.
And of course, from an energy market perspective, oil continues to drop. $85 now the handle on Brent. We understand that Iran and Oman are looking to reach an agreement to restart shipping through the Strait of Hormuz. What progress is being made there?
Yeah, Brent seems to drop by the hour. Every time we speak, it's a little bit lower, Anna. And so what we know, and this is a Bloomberg scoop that was reported earlier, is that Iran and Oman held talks to restart movement through the Strait of Hormuz. Now, we don't have a lot of clarity still about what that mechanism will look like. We have, from historic sort of evidence, stuff to suggest to us that Iran and Oman were developing a mechanism to start shipping, to start charging fees for ships that are moving through the Strait of Hormuz. We don't know if those discussions were the ones that were taking place. But look, both the United States and Iran need shipping to start making its way through the Strait of Hormuz. Yet again, as of now, ships are pretty much paralyzed because while the United States had stopped attacking Iran, it maintains its naval blockade on Iranian ports. And then Iran is also threatening all ships that are not sticking to the routes that it had laid out. So you're seeing traffic at a standstill pretty much. Very little ships are making their way through. And then parallel to all of this, on the other side of the peninsula, you have a risk at the Red Sea now, which Saudi Arabia had resorted to throughout the course of the war, really, because of the shutdown in the Strait of Hormuz. So you're seeing the parallel war or the parallel aggression between the Yemen Houthis and Saudi Arabia taking place, putting further risk on the Red Sea, on the Bab el-Mandab Strait. And so that is a risk that has emerged over the past couple of weeks or so. And so there's a distinction to be made here, Anna, between what oil markets are interpreting and the drop that we saw over the past 3 days in Brent crude prices, and between what is actually happening on the ground, and that is a paralyzed movement or a semi-paralyzed movement in ships and tankers.
Abir. Thank you very much. Abir Abu Omar, Bloomberg Horizons Middle East and Africa anchor. Sticking with geopolitics, the UK has agreed to share technology with Ukraine that can jam Russian air defence systems. The agreement to share the so-called stone cloak system came as Ukrainian President Volodymyr Zelenskyy became the first foreign leader to meet with the new British Prime Minister Andy Burnham. Zelenskyy is now in the United States and will meet President Trump later today. Let's get more details with Greg Sullivan, who joins us now. Greg, good morning. So President Zelenskyy had a tough time at home. What does he need to bring back from these trips? Of course, there's been he's been having to deal with a lot of changes in his cabinet, making a lot of changes in his cabinet. What does he need to? What does success look like from this international visits?
These are both very important visits for Zelenskyy, and he can't come home empty-handed. And he won't, as you said, already securing the technology to jam air defenses from the UK, the so-called stone cloak, which will help his own drones make it through air defenses as they continue a campaign of long-range strikes within Russia aimed at bringing the cost of the war home to ordinary Russians and increasing the pressure on Vladimir Putin. But more immediately, and especially in Washington, he'll be seeking to bolster his own air defenses. Of course, Trump said that he agreed to allow Zelenskyy and Ukraine to domestically produce the Patriot anti-missile systems at home. However, that will take a while to ramp up. So while they will discuss next steps for that system and domestically producing them, they also need to discuss how to bolster, how to fill in the gap for Ukrainian air defenses amid Russia's own airstrikes, which are turning increasingly deadly amid a deficit of these interceptors. So that will be top of Zelenskyy's agenda. He'll also look to discuss sanctions pressure on Russia as Washington looks to consider a new package of sanctions very soon. So he'll want to discuss that with President Trump. And again, all of it aimed at trying to increase the pressure on Putin to come to the table.
Yes, Greg, so it's about sanctions. It's not about peace deals, but I suppose they're trying to get towards a peace deal. How elusive is that proving to be?
Well, it looks pretty elusive from where we sit right now. Now, President Volodymyr Zelenskyy did say that last week he talked to U.S. envoys Steve Witkoff and Jared Kushner, and that they had a productive discussion about restarting diplomacy. But at the current moment, there are no signs that talks look ready to start. President Vladimir Putin has stuck to maximalist demands, including to gain territory that he does not control militarily. He has not backed away from those demands. He's even rejected a an open call from Zelenskyy to meet and negotiate an end to the war. There are also signs that the Kremlin has hardened its position, feeling that perhaps potentially some understandings that were reached with President Trump at the Alaska meeting last year have potentially collapsed. So potentially hardening that position. It does not look like there's any momentum towards restarting the talks. They've been stalled since February due to Washington's focus on the Iran war. So.
Greg, thanks so much. Thanks for the update. Bloomberg's Greg Sullivan joining us there with an update on Ukraine. Coming up, we will discuss the outlook for deal-making in Europe as the continent's companies attract renewed interest from investors. What does the M&A picture look like in Europe? That conversation coming up shortly. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Anna Edwards in London, and these are your top stories. The global chip rout deepens on AI spending fears. Slumps in Samsung and SK Hynix point to cracks in the memory chip boom. Barclays shares slide the most in more than a year, despite the UK lenders, equities traders and investment bankers beating estimates. Plus, oil and gas fall further as President Trump says there's a good chance of a deal with Iran, but Tehran denies formal talks are even taking place. Let's talk about deals. Deals targeting European companies are on course to top $1 trillion this year, recovering from a dip following the Iran war. European listed companies are commanding average premiums of 24% from buyers, a figure well above the average for the last decade. Let's discuss that, the deal's outlook, with Anna Skoglund, who is co-head of EMEA Investment Banking and EMEA head of the Financial and Strategic Investors Group at Goldman Sachs. Anna, nice to have you with us. Thank you for being here on The Pulse. So what is driving this renewed interest in M&A, do you think, in Europe?
What I would say is, and I was here in November last year, and we had predicted that we would see a resurgence in corporate M&A, and that has really played out this in the first 6 months of the year. If you look at the 20 largest deals, which we basically had 20 deals above 10 billion, 15 of those are corporate deals. And these are deals that some of them we've been waiting for some time. If you think about the TK elevator sale to Kone, that was sort of expected maybe last time around when Advent and Siemens bought the business, but it happened now. So I think, it's sort of played out. And I think it's really this volatility which paradoxically is actually driving more decisive deal making. Not making a decision and not going ahead, in this uncertainty is probably a decision as well. So we are seeing more confidence and active forward-leaning stance than we've seen in a long time.
So would you say capital markets activity is continuing despite the sort of volatile geopolitical landscape? Is that what we're seeing? Are we just more accustomed to a background level of volatility that we just have to accept as a new normal and get on with deals regardless?
Yeah, I think that's right. Combined with the fact that you have these sort of once in a generation, several generations maybe, change in technology, underlying change in technology around AI. And then you have geopolitical, obviously, volatility. But also, I would say, corporates are sort of realizing that they need to act. Corporate simplification has been a theme for some time. We are continuing to see that. For example, the Volkswagen sale of Air to Bain.
Yes. I mean, we've talked a lot about private equity over recent years and how they've, in some cases, not been able to offload companies that they've wanted to either bring to market or to sell on. Is that going to get easier? Is it already getting easier? What does it mean for PE exits, the fact that we're seeing this activity?
Yeah, I would say this. If you take a step back and just look at the overall M&A markets in volumes is up like 50% almost. Europe is actually up 90% because we've seen a lot of, the corporate deals, as I've mentioned. If you look at entries by private equity, that's also up. But it is true that, maybe sponsor M&A was a little bit slower than we hoped for in the first quarter. We've seen a sequential uptick in Europe in Q2, and we believe that that's going to continue. Now, it is this sort of different kind of deal making, selling into corporates, taking stock in exchange for instead of cash, for example. We're seeing continuation vehicles. We're seeing minority stake monetization. So the deal making is more varied. I would point out, though, that we've seen more entries and more deployment than last year. So that's really encouraging.
And you mentioned technology and how we have such a changing landscape when it comes to technology. Is that proving to be a catalyst for M&A within Europe?
For sure.
Yeah, trying to get hold of the right technology quickly.
Yeah, for sure. And by the way, if you don't do it quickly, I think we just put out this report talking about the sort of volatility paradox and also another one around AI and how it's driving deal making. If you look at the industries which have been active in Europe this year, it's industrials and business services. Last year it was TMT. So it's interesting to see how that AI technology catalyst, I would call it, is driving M&A in other sectors than strictly tech.
Yeah.
And we expect that to continue.
And how's all of this being echoed in the IPO space, in the ability of companies to come to market to raise funds? We've talked about successes this year, but we've also had stumbles, some from the defence sector, spring to my mind.
Yeah.
So what does the landscape look like for IPOs?
Yeah, listen, going public is, it's a start of a journey, I often say. And, I worked on many IPOs over my career, and, it's rare that you see a sort of straight line, particularly in this uncertain geopolitical volatility, etc. What I would say, though, capital markets are open. Capital markets want to fund growth. And we, expect the best companies to be able to come to market. Now, if you have an event which happens exactly around your transaction, it's probably not the most prudent thing to go because you do want to deliver on returns for investors from day one. So I would say, yes, capital markets are open. We expect to see continued IPO activity. But it's not going to be a straight line. It never is.
Yeah, never a straight line. The AI theme has been so dominant in the US and Asia, certainly, less so in Europe, but there are opportunities within the AI space in Europe. They just look a bit different, it seems. That's what a lot of people are telling us. So how does the AI landscape impact on Europe? Is there less crowding out of other themes in Europe than maybe is happening in the US and Asia?
Yeah. Listen, first of all, I'm super excited about the opportunity for AI and technology broadly for European companies. We have a very, very strong base of highly performing industrial companies. I mentioned industrials being one of the most active sectors in M&A this year. I think that's going to continue. Industrial tech, European companies are optimally placed to take advantage of that. So that's an exciting theme. Business services. Financial services. Listen, I think in healthcare, I could go on, right? I think what we saw being mainly a tech-based activity, maybe in 24 and 25, has already spread to other industries. And I think it's going to be a catalyst for M&A.
And if we want to get excited about that, we keep asking the CEOs about return on investment, from AI spending. And we don't always get a lot of detail on that front. And it's quite difficult. It's quite the sort of costs and benefits seem quite dispersed around the P&L. So difficult to say exactly what it's delivering. Do you see the evidence you need? Are the clients you talk to really confident that they're getting what they need from their investment in AI?
Maybe a couple of points. First of all, taking a step back, it's called a frontier technology, a generational technology, for a reason. This is going to play out over many, many years, even decades. And therefore, I understand our clients who do not want to necessarily sort of put hard numbers up front today. It would probably be a mistake to do so because it's going to play out. So what are they doing? They're identifying areas where they're going to see the benefits. We do so ourselves, be it in client engagement, be it in certain of these work streams that we have work processes that we have identified. So I understand. I wouldn't say it's a reluctance to commit to numbers. It's being strategic with this technology. And that, I think, it's the right thing to be.
And this boom, if we can call it that we're seeing in M&A and this corporate activity, does it withstand higher rates? Do you think we're going to end up in a position with higher rates than, Anna, if we get the Fed is in focus this week, the Bank of England, the BOJ, but we've seen a hold from the ECB, of course. But are you expecting higher rates, and will that disturb what we're seeing?
Yeah, listen, financing markets are super conducive. They are there to finance both strategic M&A, this CapEx way we're seeing. Rates may move. But I just don't see that putting a lid on this activity because it's strategic, it's multi-decade, and it's exciting.
OK, Anna, thank you very much. Thanks for bringing us the excitement. Anna Skoglund, co-head of EMEA Investment Banking and EMEA head of the Financial and Strategic Investors Group at Goldman Sachs. Now, Barclays shares are slumping this morning despite an earnings beat, as results showed its US consumer banking and investment bank growth there lagging larger rivals on Wall Street. We spoke to the British lender's CEO about the results.
I'm absolutely pleased with the set of numbers we've published today. You know, our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about. And to your question, we are doing this in a very disciplined way, with disciplined capital, disciplined cost control. And the revenues keep going up, the returns keep going up, and we're doing it on a fixed capital base and really sweating it. And our capital efficiency is much higher than we thought it would have been at this time. So I'm pleased with the numbers all around. I'm very, very happy with the progress in fixed income, particularly in securitized products, which is a business we've built from nowhere to being high-ranking on Wall Street. Our credit businesses are very high-ranking. Our depth with our clients keeps increasing. One of the statistics we said 2.5 years ago was with our top 100 clients, we wanted to be top 5 with 70 of them. We are now at 65 in the middle of this year. So that's great. And the UK businesses are producing over 20% ROTE. The bank itself has produced 16.1% ROTE in the first quarter, in the second quarter, and 14.8% for the full year. So we are, reaffirming our guidance very confidently for both this year and for 2028, and as you said, we've upgraded our income. The UK needs more growth and more productivity, and I think the government and both the Chancellor and the Prime Minister recognize that, and they're going to build on the foundations that their own party has created over the last couple of years, deepening the involvement of the leading UK firms and industries in the growth of the country. They say growth in every postcode, and I cannot be more supportive of that. I think there's been continued uncertainty in the markets. You spoke about AI. We've seen both a run-up in technology stocks and technology-related stocks, and now some volatility. The crisis in the Middle East continues. The crisis in Russia and Ukraine continue. The UK economy, the US economy have been robust. Employment has been strong. Credit conditions are strong. But they're facing a kind of uncertainty at a global level that's continuing and persistent and not been seen for a while. So I have to worry about that. And we protect ourselves by running good businesses, by being well capitalized. Our CET1 ratio is at 14.3%. So I'm worried, but we try to run a safe bank.
The Barclays CEO, C.S. Venkatakrishnan there. Moving to UK politics now, Labour lawmakers have warned Prime Minister Andy Burnham that he will lose the support of his party if he approaches welfare reform with a focus on punitive cuts. The pressure comes as Burnham prepares to set out plans to boost education and employment opportunities for young people. In other news, wildfires in France and Spain that forced the evacuation of more than 300,000 people have stabilised. But the start of summer's fourth heat wave means little respite for emergency services. During a visit to Bordeaux, the French president underlined just how unusual the circumstances are.
Firefighters from across France are on the ground with around 20 firefighting task forces, unprecedented aerial resources, and more than 1,500 military personnel deployed. We are facing events we have never experienced before.
Meanwhile, the Spanish government says the situation remains very, very complex. Let's bring in Bloomberg's Caroline Conan, who's actually in Paris and can bring us an update on everything that's been developing over the past 24 hours or so. Caroline, what's the extent of the damage then that we're looking at, and how stable is the situation now?
It seems like in both Spain and France, the situation has somehow stabilized overnight, meaning the fires have not spread much further. But that doesn't mean the fires have been fixed. In fact, firefighters in France are saying that today they have to fix about 100 miles of this wall of fire near the Bassin d'Arcachon in order to really circle the fire. It seems, though, that in the short term, the metropolis of Bordeaux is not threatened anymore. However, we are looking carefully at the next few hours because as soon as tonight, another heat wave is coming in both France and Spain, with temperatures rising to as much as 40 degrees Celsius and strong winds. So the situation could turn bad again.
Yes, indeed, and certainly something that the politicians will be very aware of. The Spanish Prime Minister saying that summers like this are the new normal, Caroline. President Macron saying that this is a situation that France hasn't seen before. Are these fires, then, are they likely to provoke more thought, more action, a new course, a new plan for dealing with climate?
It is possible. And in fact, if you look at the cost of these fires, we have the Spanish Prime Minister Sanchez doing a press conference later at midday. This situation in Spain is slightly different because fires have been considered as emergencies. This means that there will be some kind of emergency funds opening the door to financial aid in those affected in those areas around Madrid. The situation is different in France because fires are not considered, they are not included in what we call natural disasters, natural catastrophes in France, such as storms or floods, for example. That means that the insurance companies, at least in France, are going to bear most of the cost. The finance minister, Roland Lescure, was saying yesterday that the insurers will cover about 3 weeks of those people who have been evacuated and had to relocate. But of course, you have to look at the businesses. We're still in the middle of the tourist season. It's really the middle of summer in those regions, especially around the Cap Ferret Peninsula, where people have not been able to come back. Restaurants, hotels are still closed. There's no one in the streets. It looks like a dead zone, really. And these areas have about 8,000 people in winter, but they have more than 100,000 people in the summer. So far, about 13,000 businesses have been affected, and about 130,000 people are out of work, according to the Finance Ministry. There's going to be a crisis meeting at the Finance Ministry in Bercy on Thursday in order to give some answers, but clearly there will be a lot of debate about a long-term impact of these wildfires that are raging every summer. In France, 115,000 hectares, that's the worst in 2 decades. In Spain, it is also the worst since World War II. So clearly, there will be some questions about how governments can include these fires into natural disasters, natural catastrophe schemes. And we'll be talking also to the AXA CEO on Friday, one of the biggest insurers in France. That's going to be very interesting.
Caroline, thank you very much. Bloomberg's Caroline Conan setting out the details there of those wildfires. Let's pivot to some other news. This out of Japan. Japan's meteorological agency says an earthquake with an estimated magnitude of 7.1 has hit the country's southwest. The runway at Kumamoto Airport in Kyushu is closed. It's not known when it will reopen. Train services and some phone networks have also been affected. Kyodo is reporting that TSMC evacuated staff from its plant in Kumamoto. TSMC, Sony Group and Tokyo Electron also have plants in the region. Japan's chief cabinet secretary says no abnormalities have been observed at nuclear power plants in Japan. 9:47 here in London. Coming up on the programme, Mercedes shares. They're gaining today despite a slump in China, and we'll get further details on that ahead. This is Bloomberg.
One is cost and freight. The other is also chip cost. So there is materials cost inflation that we see coming through. There are two drivers. Those are the main drivers, and those we need to mitigate. So we have accounted for a rising inflation, including these and also including prices for those. So that actually is what we are offsetting and what we planned for. We also, if you look to one we guided at the beginning of the year, we also built in a margin, a buffer for unforeseen external developments.
That was the Philips CEO, Roy Jacobs, speaking to us earlier this morning. Shares are under pressure this morning after that warning of rising cost pressures, with the adjusted earnings margin in its key diagnostics and treatment unit falling in the second quarter. So that's the Philips story. Let's move on to Mercedes, where shares are climbing this morning after the car maker reported resilient profits that beat expectations. That's even as deliveries fell due to a slump in China. Let's get more now with Elizabeth Behrman, who leads Bloomberg's coverage of EMEA autos. Elizabeth, good to speak to you this morning. So investors appear to have welcomed these results despite the challenges in the Chinese market for this business. What's the story?
Yeah, I mean, to be clear, Mercedes' profits still slid quite a bit, more than 1 percentage point to about 4% on the all-important car-making unit. And what Mercedes was able to do, as we've learned this morning, is the cost-cutting efforts that they've been putting in are resulting in some measures to underpin the business. Development spending has also been lower, and that's due to a lot of the big spending requirements on the electric vehicle transformation sort of having seen its peak. At the same time, the China challenge absolutely remains for Mercedes. In China, they sell a lot of the S-Class sedans and the related Maybach sedans that are key to the profits for the company.
Yes, and I saw that sales of those were related to the property sector, which has been an area that's been struggling in China. So what's the outlook for the second half of the year for the business?
Yeah, the company put a lot of emphasis on the second half of the year, where they expect to get lots of benefits from sales of new products. The company is working on the rollout of some 40 refreshed or new models. So that's good news in terms of garnering sales momentum. What's going to be really interesting is how some of these products will do in China. One of them that we'll be paying a lot of attention to is the electric GLC SUV. It's generally one of Mercedes' best-selling models, and that's going to go on sale in China within a few weeks. And it's in that area of SUVs that are premium, but sort of mid-range premium, where a lot of competition is present in China from the likes of BYD, from XPeng, and what the issue there is that the competitors are able to offer these cars at prices that outsiders, Mercedes, BMW, Audi, are really struggling to match.
Elizabeth, thanks very much. Bloomberg's Elizabeth Behrman with the latest there on Mercedes. On to LVMH, where the key fashion and leather goods unit, home to Louis Vuitton and Dior, barely eked out sales growth last quarter as the conflict in the Middle East deterred wealthy shoppers. Organic sales at the division, the group's most profitable unit, rose 1%, missing the 1.52% estimate of analysts surveyed by Bloomberg. Let's bring in Bloomberg's Angelina Rascouet, who covers luxury for us from Paris. Angelina, what stood out then most to you from these results?
Hi there, Anna. I mean, indeed, it was on the positive side. The key fashion and leather goods units returned to growth the first time in 2 years. However, as you said, it was a slight miss on the growth number. It was led by, Christian Dior did slightly better than the unit average, so that's relatively positive because they have a new designer. He's put out new collections, and there were fears that perhaps it wasn't doing so well, especially because they're facing competition from Chanel, who also has a new designer. So Dior did slightly better than the unit. Louis Vuitton was in line. So so that's on the positive side. But I think there's still question marks, and that's potentially why the stock reacted negatively this morning. When it comes to growth in China, I mean, we're still not seeing strong recovery sign. And the other unit that actually did positive was the watches and jewelry unit, led by the jewelry unit. So that means Tiffany and Bulgari, and that's something we had seen as well with Richemont. Richemont, you know, its mega brands, Cartier and Van Cleef did really well, and that probably means that in times of uncertainty, consumers are keener to spend on gold products rather than perhaps leather goods and accessories.
And Angelina, what are you looking for from Kering and Hermes? These results still to be reported.
Indeed, so Kering will be tonight. Kering, I mean, it's in the biggest brand is Gucci. Gucci, we know it's been in turnaround mode, so we are expecting quarterly sales to be negative, but slightly less negative than in the first quarter of this year. The company is in a turnaround mode, and I guess investors probably have to be patient. We know that I mean, the market is expecting the Kering jewelry unit to be positive, just like the rest of the sector. And tomorrow we have Hermes, and the big question mark regarding Hermes is whether they have to manage the difficult decisions of whether to keep growing their leather goods units. So that's the one that includes, you know, the Birkin bags, the Kelly bags. But at the same time, how do you preserve brand equity if you keep growing that unit?
Angelina. Yeah, absolutely. Thank you very much. The perennial question in luxury goods, Angelina Rascouret, with the latest on the luxury sector. Up next, Bloomberg Brief will continue to count you down to the start of the US trading day ahead. European stocks making modest gains this morning on the back of earnings. This is Bloomberg.